Well, hello, everyone. Welcome back again. Thank you for tuning in to Mark and I's quarterly video. And I guess in this instance, it's our year-end video for 2022. We hope you had a great Christmas and New Year's with your family. And we're just going to start by taking a look at how 2022 went, the year in review. You know, if we look at the markets, honestly, 2022 was a tough year in markets. That's
okay.
and
You got to give us some numbers to give that some color, man.
Yeah, absolutely.
It was a bad year.
Yes.
Well, Tarek grabs his numbers. I will tell you that the S&P, the Standard & Poor's 500 stock, had one sector that was up last year. Energy, up a measly 59%.
Right.
And every other sector was negative. Anyway, back to you, Tarek. What are some of your numbers?
And I think, you know, it's wild to think that sector was up as much as it was because the S&P 500, which is, you know, the biggest 500 companies in the States, overall, it was down, I think 18. Let me just pull it up here.
I saw a number this morning, 19.44%.
Yep, it was down 19.44%, 18.1 if you count the dividends. So that's in spite of energy being up by 59%, which would a number of those companies would be part of the S&P 500. So, you know, that's just to say that other sectors performed, you know, obviously much worse than that. And so that's the biggest market.
How did Canada do? Was it down?
The TSX was down 5.8. If you include the dividends, down 8.7 if you just look at the prices, right? So and we're a big oil and gas market, as everyone knows as well. But still, it was a challenging year. It was a year of correction, and that's the word people throw out when they talk about negative years. But I think we really mean correction because the numbers were definitely inflated at the end of 2021. Things were way too high. They didn't make any sense, and so we're coming back down to reality, or we've come back down to reality, and that's kind of what 2022 was. It was painful, but we're back
Tarek,
here.
One more question on sort of the market. Last year, we said this is, in our opinion, a bond hostile market.
Mm-hmm.
We were cautioning people about having too many bonds. You've got a BlackRock bond index that you watch. What's its number for last year?
Yeah, absolutely. So it's a Canadian Universe Bond Index too, and it's down 11.8%. And so that was, you know, we were correct in that, you know, rates are going up. So bonds responded, very negatively to that. And so that was also the challenge, as well as that, generally speaking, portfolio management theory is that your bond portfolio does better.
Supposed to be safe. Yeah.
Yes. They're not supposed to move in the same direction at the same time. You're not supposed to have your equities fall at the same time as your bonds. So that was, presented some more challenges for portfolio managers and for portfolios. But, it's 2022 is behind us. We're going to look forward to 2023.
Right. Okay. So let's do two thoughts next. What do we think about the market coming up? And I'll start with that answer, and then you can jump in, Tarek. Okay. And then the second is, how did we do in that market?
Exactly.
The bond call worked last year. We think that's probably not the case for this next year. We probably think that rates are at least flat. I would argue that they're going to start dropping as the inflation shuts down and then interest rates start to come back down. So our call for last year of get away from bonds. If you're in bonds, you should stay there, because it is a much better environment for bonds to perform well. I don't know that they'll be stars. I don't think that's quite the right case, but so the bond market is likely a safer place to be this year. The equity markets, I think, are quite mixed looking ahead. What are your thoughts on that?
Yeah, I think equity markets are definitely going to be quite mixed. What I would say is, I think rates might still go up a little bit this year, but I think equity markets reflect that. So the markets are already pricing in that information. Mm-hmm. And so I think this year, we've kind of mentioned it before, but we're going to see equity markets do what equity markets are supposed to do, and that's give value to companies that are creating real and tangible value, that are generating strong earnings. Whereas previously, with rates being so low, it was kind of like any company that sort of had a bit of a good idea was getting their valuation really pushed up. And so this year, I think we'll see a switch to, okay, if that company's doing well, it's going to do well, and we're going to see it across different sectors and across different spaces.
Okay. How did we do? in this environment of 5.8 TSX, negative 18%, negative 5.8 in TSX, negative 18% S&P, negative 12% bonds. How did we do?
Yeah, and it's good you mentioned that too, because our portfolios generally include aspects of every market that we've referenced. So if we look at our Canadian momentum strategy first, now this is, if you're invested in it, our more aggressive strategy. We're looking to beat the Toronto Stock Exchange in a given calendar year, and we're happy to report that for 2022 we were up 2.6% at the end of the year, compared to, as you mentioned, minus 5.8 for the TSX. So strong outperformance on the momentum portfolio of close to 7% or close to 8%. And so that's great, and really, really happy with that. Now, if we move on to our enhanced index portfolios, so at the higher end, we have aggressive growth. That was down 3.6% for the year. So again, always tough when it's a negative number, but considering the benchmarks we've provided, happy that, we're not looking at minus 18 or minus 12 or even, minus 5.8 in this situation. Now, if we go down in the enhanced index, we'll just give you an example, the balanced enhanced index portfolio, that's down 5.8%. Now, at first look,
okay, so it matched the S&P's negative return, but it had a whole lot of bonds.
TSXs, yes.
TSX, right?
Yep. And that's a good point. It had a whole bunch of bonds in it. So the bonds down at 11.8, 12%, whatever. TSX is down 5.8, and we managed to eke out 5.8 on the balanced fund. Now, generally speaking, some of you might be thinking, well, the balanced fund's supposed to be the more safe option. Why did it do worse than the aggressive growth? And that's because of what you spoke to before. It's more bond heavy, and so more bonds, as you saw, we're sort of dragging returns last year, and so that's why the balanced fund did worse. In case anyone's wondering why that happened, but yeah, overall, I think in comparison, we're quite happy that outperformed those benchmarks over that time.
Okay, let's talk about our strategies, because we're actually not stock pickers and we're not sector pickers. We are sort of systematic strategists.